Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I am your host, Christopher A. Paniotu, certified financial planning professional, the Cap and Capitalize. And on today's episode, I'm going to dive into 6 planning steps for people in their 30s and 40s. But as always, before we get into the meat of the episode, the free advice for the week. And it's short and sweet. The more difficult it feels to accomplish, the more reason you need to do it. I told you, short and sweet. And now that we've got that free advice out of the way, it is time to get into the 30 and 40-year-olds that listen in. So people in their 30s and 40s, that's generally a period of growth and change for the better. And I'm going to speak for myself personally, being 34, almost 35. In my mid-30s, your growth is exponentially greater than in all of your 20s put together. And that's where compounding works just in wonderful, wonderful ways. Now, in terms of what those changes look like, the list is endless, but the big ones, you kind of already know them. Maybe you get married, have kids, buy a house, not in any particular order. Now, when you hit your 40s, that's where people jump even more mightily in your careers, financially, because compounding works, again, in magnificent ways. But then if you have kids, you're watching them go off to college or, nearly go to college or post-grad of some kind. And the most difficult part of these 2 decades, it sounds really simple, but it is definitely not easy. It's balance. It's balancing everything. And with that being said, I want to get into the 6 planning steps for people in their 30s and 40s that you're really going to need to hone in on. And the first one is, I think, pretty obvious. I think you're going to think so too, but you need to hear it. You need to make sure you're contributing to your retirement. And it's important for you to contribute as much as possible to your company's retirement plan if you work for a company, and assuming you have access to one. And if you work for a nonprofit, it's a 403B. If it's a government entity, 457. If you're in the military, TSP, things of that nature. Now, obviously, you're not in your 20s, so yeah, you don't have as much time until you retire by definition, but you still have years to compound into a fantastic retirement. And at the very least, you're going to want to make sure that you contribute at least the company match. Now, once you put into that company match, whether it's dollar for dollar up to 4%, 50 cents on the dollar up to 5%, whatever that percentage number is, you got to put in at least that because it's free money. But once you get there, what I want you to do is consistently inch your contribution percentage higher until you are able to max out your contribution every single year. Now, I want to be very, very clear on something. Just because you are not able to max out your company retirement plan, this does not mean that you won't have a successful retirement. And all my point is with that is by focusing on you contributing more and more and more to your company retirement plan, as it's not only going to help you, just with retirement planning, but indirectly, it also makes your financial picture that much more simple because you don't have money all over the place. You can just focus on one thing and then have all the extra time in the world to do other things. And I can make an argument, I'm not going to go on a tangent, but by having less things to focus on, you're going to compound your wealth that much better. Now, for reference, in 2026, the maximum employee contribution to a 401k plan, which is really the majority of you, this is what you need to know. It's $24,500. Now, if you are 50 and older, there is a catch-up contribution of $8,000 that can be made for a total of $32,500. Now, this is where it gets to be a little interesting. In 2026, the maximum 401k contribution, if you are between 60 and 63, is $35,750, which consists of the standard $24,500 with a bonus catch-up contribution of $11,250. Now, if you added up what you can put in as an employee, as an employer, like a match, and a profit sharing, the total combined amount for all of that is $72,000 if you are under 50. If you are over 50, those proper catch-ups are added and applied. Now, you really only need to know that if you run your company or if you're an executive that has control of your 401k plan. But again, $24,500 if you're under 50, $32,500 if you're above 50, and if you are the coveted few between 60 and 63, $35,750 is the max you can put in for your 401k for 2026. Second planning step, build an emergency fund. My God, if I had a penny for every time I said this on this show. I'm going to keep saying it till I'm blue in the face. It is arguably the most important foundation for your financials in terms of today. And if you're in your 30s and 40s, you know this, but I'm going to reiterate it. Things happen in your 30s and 40s, and those things happening could be much greater if you have more on the line. Family, kids, maybe you're helping out with extended family, etc. 3 to 6 months is generally advised in terms of emergency fund based on your expenses. However, there is a balancing act between having enough money while also not becoming a hoarder of cash. As you're actually there is a risk to that. A lot of people think, oh my gosh, there's no risk in having cash. Sure there is. There's purchasing power risk, which is inflation. There's just inflation risk in general. So by balancing all of that, you're making sure you're not shooting yourself in the foot by just stuffing too much cash away. But emergency funds, it's going to be paramount. Third planning tip you need to know. Life and disability insurance. One of the most uncomfortable things to talk about in the world of planning, but it's very valuable. Once you are in your 30s and 40s, and your financial situation begins to compound, it gets more and more dicey if you have something happen to you that could derail all of your hard work and savings. And there's two of the big ones, obviously, dying and long-term disability. Now, if you have a young family that's counting on you, life insurance, it is a no-brainer. Most of the time, people in their 30s and 40s, they haven't had enough time to compound enough wealth to keep their family afloat if the worst case scenario actually happened. So life insurance would be enough. You would purchase enough of a death benefit on life insurance to cover this. Now, in terms of, do I buy a term life insurance? Do I buy a permanent life insurance policy? Do I do a combo? I kind of want to move on from this for this episode because we've talked about it a little bit in the past. But just for the purpose of this episode, you need to know that it's not an either or, it's generally an and when it comes to permanent and term life insurance. And there's going to be a balancing act between the two. And as a rule of thumb, what I like to use again, this is not a recommendation for compliance people. Generally, what I look at is if someone comes in and let's say that they've got, a mortgage, student loans, car loan, things of that nature. I like to buy a term policy for that amount. And then what I do is I buy a permanent policy for, let's say it's not the full amount, it's the difference. And then I may add a little bit more to the permanent life insurance death benefit for if someone passed away. Sure, your family members are debt free, but they also have no income because you were the primary breadwinner. So replacing some of that. So again, I just wanted to throw ideas out there to get you to think. This is not a recommendation, but that's how I think about permanent and term life insurance. Now, fun fact, you have a greater chance of becoming disabled versus dying when it comes to your working years in terms of your younger years. Because technically your chance of dying is 100%, but let's move on from that. Disability insurance, it's definitely not fun to talk about. It's definitely not fun to pay for. I would say 15 out of 10 times clients that we've worked with are annoyed about paying the disability insurance policies. I get it. But if you need it, you will be extremely thankful you bought it. Now, the good news is you can most likely get either of these, meaning term life insurance, in some cases, even permanent life insurance, or disability insurance through your company. And that is going to be infinitely cheaper as opposed to going and buying it on your own. If you own a company, setting up these types of benefits are actually fairly inexpensive. So it's going to be a win-win for everyone. And that being said, I would strongly suggest that you look into getting both private insurance as well as using your company's insurance because, again, 30s and 40s, stuff happens. So if you go to another company and they don't have that insurance policy benefit that you had at your previous company, but you still need it and you need to go and now take out more private insurance. Well, as you get older, insurance gets more expensive. So you want to balance all that. So don't go anywhere. Stick around. We're going to come right back and get into the last 3 planning steps that people in their 30s and 40s need to know.
Are you ready to transform the way you approach sales? This episode is sponsored by the second book in the Capitalize series, Capitalize Your Sales, the all-in-one sales framework that saves you from ever struggling again and teaches you how to sell with sincerity, which dives deep into the art and science of driving sustainable growth. Packed with strategies that go beyond surface-level techniques, this book will help you understand what it takes to truly connect with clients, build long-term relationships, and close deals. Whether you're looking to fine-tune your sales craft or break through to the next level, Capitalize Your Sales offers a roadmap to success designed for today's fast-paced business world. Head on over to your favorite bookstore, order today, and start capitalizing your sales immediately. And now, back to the episode.
Welcome back from the commercial break. We're going to get right into number 4 in terms of the planning steps that you need to know if you're in your 30s and 40s, which is getting your estate plan done. Even though you are in your 30s and 40s and you may not have accumulated a ton of assets, it's mission critical to have your estate plan dialed. Beneficiaries on retirement accounts, insurance policies, trusts, basic wills put in place. These are all very easy to look up or get squared away with an estate planning attorney. And lastly, I'm just going to give you a tidbit because we're going to move on from this, but titling assets is super, super important for non-retirement assets. So ask your estate planning attorney about that when you chat with them. Number 5, college savings for the kiddos, assuming you have kids. And if you're in your 30s and 40s and have kids that you are planning on going to college or post-grad of some sort, start saving for that pronto. Schooling, unfortunately, it's not getting any cheaper. And most people can cut these, they can't just cut these checks purely out of their income. And there's many ways to go down this path. The most popular and most valuable for specifically college funding is going to be a 529 plan where your money goes into these accounts after tax. The investment gains are tax deferred, so the money grows tax deferred. And then if you use the funds for qualified educational expenses, which there's a pretty decent amount of them, all of that gain is tax-free. Also, fun little fact about a 529 plan, you can roll up to $35,000 of unused 529 plan money into a Roth IRA if it has been around for at least 10 years. So that's a nice little bonus. And also with a 529 plan, there are some cases that allow you to fund kindergarten through 12th grade with 529 plan money. Now, before we get into number 6, there is one thing I want to, and I'm going off I'm going off script here a little bit. I'm not saying college planning is not important if you're in your 30s and 40s for your kids. I did mention you want to start saving for this pronto if it's valuable to you and important to you. All that still remains. I do want you to know, however, that if your kid needs some help when it comes to college planning, you can get help. Your kid can get help. Grants, student loans, public, private. They could work. There's a lot of different tools. You're not going to get any help in retirement. That's all on you. So what I've told people that are in that weird boat of, well, I want to save for college for my kiddos, but at the same token, if I'm not saving that amount into my retirement, I won't be able to retire. You got to have a serious conversation with yourself in the mirror on that. So just wanted you to think on that one because that is something, again, we all want to provide for our kids in the best way possible, assuming, you're not like a absolute jerk of a parent, but there's a balancing act where you got to help yourself first. Now, the last planning step that you're going to need to know if you're in your 30s and 40s, manage your freaking debt. Many people in their 30s and 40s are still paying off their student loans, which, again, nothing wrong with that at all. It's just a fact. You also add personal loans on top of that, mortgages, credit card debt. It can get really overwhelming really, really quick. All of these debts can hinder you saving up assets because you're drowning in liabilities. Now, it is worth remembering something. Not all debt is bad. In fact, there are some good debts out there. And some of that's in my first book, Good Debt versus Bad Debt. Reinvesting in yourself, as an example, it is a fantastic debt to take on, and there will be a return on investment at some point, assuming you actually use what you're reinvesting yourself with. That being said, accumulating too much debt, it's obviously going to hinder you in a negative way. But don't go the Dave Ramsey route where all debt is bad and you're an idiot if you have a ton of debt. That is not true. But don't go the Robert Kiyosaki route where you just drown in debt because he thinks that somehow you're just never going to pay taxes ever again on that money. That's absolutely psycho. There is a blend between the two, and that's where you need to focus. So that does it for today's episode on the 6 planning steps for people in their 30s and 40s. As always, I'm your host, Chris Frey-Paniotu, certified financial planning professional of the Cap and Capitalize. And until next time, keep capitalizing. Take care. As always, thank you for joining me today. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris at capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Chris Frey-Paniotu, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. Content in this material is for general information only and not intended to provide specific advice or recommendations for any individual. 401(k) benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. Prior to investing in a 529 plan, investors should consider whether the investor's or designated beneficiary's home state offers any state tax or other state benefits such as financial aid and scholarship funds and protection from creditors that are only available for investments in such state's qualified tuition program. Withdrawals used for qualified expenses are federally tax-free. Tax treatment at the state level may vary. Please consult with your tax advisor before investing. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates and a 10% penalty eligibility tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. A plan participant leaving an employer typically has 4 options and may engage in a combination of these options. 1. Leave the money in their former employer's plan, if permitted. 2. Roll over the assets to their new employer's plan if one is available and rollovers are permitted. 3. Roll over to an IRA. Or 4. Cash out the account value. Christopher Panayotou is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Capitalize Your Finances, LLC is a separate entity from LPL Financial. Capitalize Your Finances is not registered as a broker-dealer or investment advisor. CRPS conferred by College for Financial Planning. The people and/or companies mentioned in this podcast are not affiliated with or endorsed by LPL Financial or Capitalize Your Finances. Insurance services offered through LPL Financial or its licensed affiliates. CA Insurance License number 0518721. LPLIA California Insurance License number 0B91442.